Okay, welcome everybody to this webinar with FX Street. We're going to talk about range bars and do some analysis using the range bars. Before we get started, as always, we need to do a little disclaimer, which basically is just saying the content of this webinar is for educational purposes only. Excuse me there a second. The content of this webinar is educational purposes only. It's not trading advice in any way whatsoever. Obviously, we will show you what we're looking at, but then it's down to yourselves to go away and decide whether it's right for you. Okay? But hopefully you'll see some value in this in any case. A little bit about myself. My name is Alex Ong. I'm co-founder of a website called Traders Corner, which I run with my brother. Written some articles, some FX manuals, producing video courses and all of that kind of good stuff. So you can find a little bit about us. A lot of the majority of the stuff on the internet you'll find on FX Street in any case, because we do quite a lot with FX Street, so it's a good place to be. Okay, what I'm going to do before we start looking at the charts themselves, I want to give you a brief overview as to how we set up our charts and everything, because that will just save some questions for later, if that's okay with you guys. So obviously we're talking about range bars here. Now just a quick, probably it's better if I ask who doesn't know what a range bar is. Is there anybody here on the webinar that's never heard of a range bar at all in their life, and have they come to this webinar expecting to learn about trading a range bound market as opposed to a range bar, or a constant range bar as it's known? No? Sylvester, you know what it is or you don't know? Would you like a brief explanation? Okay, I'll do it for the benefit of Michael. Basically, in the FX market, we primarily deal with time-based bars, right? If you're trading some of the futures, then you may have come into contact with a volume bar or, something like that. And ultimately what that is, their bars based on ticks. But because in the FX market, there isn't really any centralized exchange, you don't have the same benefit of the time and sales and the tape and all of that type of thing. So we're kind of left with time-based bars, which is fine. But the problem that I personally have with time-based bars is that a lot of the time, well, all of the time, they stop and start at some arbitrary random moment in time. Okay, so if you're trading a 5-minute chart, every 5 minutes a new candle will start to print. Now, the problem with every 5 minutes is that there's nothing significant really that has to happen within those 5 minutes for the candle to change and possibly to give you an entry signal or something like that. Whereas with range bars, they're purely price-based bars, and you hear a lot of people talking about price action and price action is the way to go and all of this good stuff. But ultimately, it gives you a much better view of price. It gives you a much better perspective of where the support and they form upon a certain, yes, exactly. So you could say that you want an 8 range bar or a 10 range bar, and what that will mean is that from the low point to the high point of the bar, you will get 10 pips. And then from the low to the high of the next bar, it will be a range of 10 pips. And generally what it does, it tidies up your charts a little bit, and it gets rid of some of the market noise. It doesn't get rid of all of the market noise. That's impossible to do. And if any of you guys have the invention for that, please let me know. I'd love to know. But so far, I haven't discovered anything that's going to completely eliminate market noise. But range bars go a good way towards doing that. So what that allows us to do is to trade the pure price action. Similar to Henkai-Ashi. Yes, similar. I don't use Henkai-Ashi. Henkai-Ashi, I believe, are more sort of averages in price, whereas the range bars are the pure price. So at any particular time what the level of the price was. Okay, so it's more price action based bars. Now the benefit of this, as well as eliminating market noise, as I said, is you're able to see the support and the resistance levels much more clearly. You don't get as much messing around the support and resistance levels as you would on a time-based bar. The price will come back down to the level and it will reverse, and hence it's easier to get your entry signals from that. Okay, does that kind of clear up range bars for you guys? I know it's very quick, and there's a couple of webinars on FX Street that you can find where we go into more depth on range bars. But for the moment, does that kind of help you guys? Excellent. So, first of all, the way that we set up our charts. Now the three primary things I have on we'll do some research. Excellent. Okay. Now the primary indicators that I have on my charts are moving averages. Okay. Now the moving averages I have are the 20, the 60, and the 100 exponential moving average. Now, to be honest with you, that could be the 25, the 55, and the 95 moving average. Is not going to make that much of a difference. The thing with indicators is that you can't trade purely based off of indicators. You have to have an idea of market conditions and understand how price actions work, and then you can use indicators to help support your decisions. Okay? Does that make sense to you guys? So you're not going to take an entry purely because an indicator says do something. You're going to do it if it aligns with the rest of your analysis. So you look at the price first of all, and then you can have the indicators on your charts to give you confirmation. It's basically, the way that I look at indicators is it helps give you confidence to enter a trade. Do you guys follow that? All right. So it's not going to be the reason that you get into a trade. It just helps you, the individual, the person, to pull the trigger, because we know we're all human beings, and human beings, we tend to do the wrong thing, and we let our emotions get in the way of things. So you can use an indicator as your comfort blanket, so to speak, but nothing more. So, as I said, on the charts, primarily what we use are the exponential moving averages, the 20, the 60, and the 100 exponential moving average. And the range bars that we use to trade are the 50 and the 25. The 50 range bar is the primary chart, so we use that for the direction that we're trading, and we wait for everything to be aligned on the 50, and then we can look at the 25 for entries. And generally you'd use the 25 for entries when you've missed an entry on the 50, for example. So you're used a lot in futures. Yes, Harley, exactly. So the 50 is the one that you primarily trade off of. If you happen to miss an entry on the 50 range chart, as opposed to chasing the price, which I know that many of you and myself have done in the past. So as opposed to chasing it, what you can do is you can wait for a setup on the 25. Range of 50 and 25, Boyke. Okay, so let's say, for example, you get your entry on the 50 range chart, you've just missed the entry, you hate yourself, and you're looking for another entry. As opposed to trying to jump into the trade and say, you know what, it doesn't matter, this is going to go up to the sky, I can get in wherever and it's still going to go up. As opposed to doing that, you wait for the 25 range bar to give you a similar setup that I'm about to show you now, and then you enter off of the 25. So, some of the move might, yes, the 25 and the 50. So the 50 pips is the primary one, and you use the 25 pips for entry if you happen to have missed an entry on the 50 pips. Okay? So does that make sense to you guys? Yes, maybe, could be. Clear, wonderful. So what's the approach? It's a trend following approach. It's a swing trading approach. Now I know you hear pretty much everybody in the market talk about, follow the trend is your friend and all of this. And to be honest with you, it is correct the majority of the time. Now, we know that markets range and we know that markets can consolidate. But in reality, we also know that if you're in the direction of the trend, when the trend is in motion, then you're going to have a higher probability of success than you would in a range-bound market. Okay, well, that's just my belief anyway. I mean, I do know some people that trade range-bound markets and like to buy support and sell resistance in a range-bound market. I'm personally not one of those. I prefer seeing a trend in motion and then buy the pullback. So buy support whilst you're in a trend. Okay, and we'll show you some of that when we come to it. So, permission to look for a trade. And this is very, very important. You need permission to trade, okay? Because otherwise what you end up doing is you end up chasing trades. A trade will stop you out. Maybe you'll be long. It stops you out to the, you get stopped out of your long trade and suddenly you want to go short because you feel like there's momentum to the downside. And then you just get into this rut and all you do is you destroy your account. So what we're doing here is we're looking for permission to enter the trade. And your permission comes in the form of the moving averages being lined up. So for a long position, you want the 20 to be above the 60 and the 60 to be above the 100. No exceptions. If that's not the case, move on, look for different charts. I'll show you how we're going to time the entries in a second, trying trader. Okay. For a short position, you're looking for the 20 to be below the 60 and the 60 to be below the 100. If that's not the case, move on, or good night, turn your charts off and wait until a better opportunity comes along. You really need to adhere to this stuff, guys, because it is going to save you money in the long run. Yes, there are swings and roundabouts. So yes, of course, you're going to miss some opportunities by waiting for the moving averages to line up because, you know, every indicator more or less is pretty much lagging, because it's based on price and it's based on what price is just done, not what it's doing. But it's one of those things that you have to accept because it will keep you out of choppy markets. It will ensure that you get in for the majority of the time into markets which are moving in a specific direction. Okay? So that's your permission to trade. It doesn't mean that you can trade. It means you're allowed to look at that chart. Okay? That's number one. Now, we look to enter on a pullback. Now, trying trader just asked, how do you enter on a pullback? What's your trigger? How do you time your entries? For us, we use the biggest tool for us is a trend line. So we look for a trend line break back into the direction of the trend to look for our entries. Okay, and I'll show you some of that on the charts when we come to it. So what we're looking for is we're waiting for price to be moving in a certain direction. We'll then wait for price to pull back. We'll then draw a trend line. Once the trend line is in place, we look for a break of that trend line, and then we get into our trade. Okay, and we place our stop behind the most recent swing. All right, so if you're in an uptrend, you place your stop behind the most recent swing low. If you're in a downtrend, you place your stop behind the most recent swing high. Okay, does that make sense? And then finally, you're looking to take profit, or at least take some of your position off of the table before you get to the most recent, to the nearest support or resistance. Okay, because ultimately what we're trying to do as traders, we're trying to make money, right? And for us to make money, we want as few roadblocks in the way as possible. And, you know, the most recent swing high or low that you're about to be trading into represents one of those roadblocks. So it's not always possible. Sometimes you just have to suck it up and take the position and trade through one of those levels. But if you can, it's very, very nice to be able to take some of your position off of the table before you get to one of those points. So how do you take part of your position off the table? Well, basically, let's say, for example, you've entered a 100K position. I can't speak specifically for everybody's brokers, but I can tell you how it works for us. What we do is we would then, let's say we put 100K on the table. We would then take 50K off or 20K off or something like that. So you can take a proportion of your trade off of the table. But the actual mechanics is how you would do that with your particular broker or spread betting company. I can't actually comment on that here because we won't necessarily use them. Okay? So, yeah, so we look to take our profit off of the table at the nearest support or resistance level. And we're always looking for a positive risk reward. Now, I say this all the time. I know the gentleman before me mentioned that you don't always need a positive risk reward, and that's true. I know traders that have a negative risk reward, but their strike rate is amazingly high, and they make money off of that. But let's be honest with ourselves here. We're human beings, and we're going to make mistakes. So if we can find a system that allows us to make mistakes and still come out ahead of the game, isn't that the type of system that we want to trade, the type of approach that we want to trade? Okay, if you're a very, very talented trader, then of course you could trade a negative risk reward because you don't make mistakes. You know, you can turn up to your trading screen and just trade and make money, and that's fine. Some people can do that, but the majority of the retail traders anyway, they aren't in that position. So let's go for a positive risk reward here because it means that you can make mistakes and you can still come out ahead of the game. Okay? And finally here I have look for momentum. Look for momentum is so important. You don't want to be trading a chart that's kind of meandering sideways and not really going anywhere because that doesn't give you the highest probability of success. And yes, it can get boring, and I've made the mistake myself in the past where I just want to take the trade and I'm trying to get into the trade before it's actually moved, because I'm thinking, if you're in there early, then you can make a lot more profit, and that's fine when that happens. But the majority of the time, that isn't the case, right? So you're always looking for momentum on your charts. How do you see momentum? A lot of people ask this, and momentum is quite simple, really. Momentum comes in the form of a chart that's moving in one direction with few pullbacks or few stopping instances in between. But we'll show you this on the charts in any case. So that kind of concludes our part for giving you the explanation on the system. Do you guys have any questions at all before we get involved in looking at the charts? Clear, Harley? Excellent. Dave, I don't use a time frame as such. It's a range bar system, so we use a 50 and a 25 range. I do use the daily and the 4-hour charts to get some perspective and some context on price, but ultimately we're trading from the 50 and the 25 range chart for swing trading. So far so good. Wonderful. Okay, let's go to the charts here, and we can start to see what's lining up for us. Can these MA serve as a potential support and resistance? Yeah, I mean, moving averages, you can kind of treat them as dynamic levels of support and resistance, because generally when price gets to those levels, they do tend to bounce. They're not bouncing because they've reached those levels. Okay, let's be clear on that. You can't say, and it bounced off of the 60, it bounced here because the 60 moving average is there. That's not necessarily the case. There'll be another level of support or resistance somewhere on your chart as well. Okay? So, okay, let's go take a look at the charts. And just while I'm changing over here, the other thing that we like to see is we like to see support and resistance. So previous levels of support become resistance and vice versa. That's ultimately what we like to see for us to trade. Now, can everybody see the charts here? Can you see the euro dollar in front of you? Yeah? Okay, so what we're going to do for the analysis, we'll briefly work through the majors. We'll talk about what's setting up or not, as generally is the case at the moment. You guys have probably seen before that in this past week or so that the markets have been pretty range bound. We had some good moves towards the end of last week, and this week has kind of just done absolutely nothing. So we'll go through the charts in any case. Let's close this down a second here. Bye-bye. Okay, so the euro dollar. What do we have in front of us at the moment? Well, from the 50 range part, for all intents and purposes, we're pretty much in a consolidation mode. We do have momentum to the downside, and personally, our bias is to the downside on this particular pair here. There's so much going wrong in Europe right now. It's hard to ignore. So we're biasing a move to the downside, but we do want to see some more momentum here. Off of the 50 range chart, I'm looking at this right now. I'm thinking, okay, so I've got the moving averages pointing down. That's fine. I kind of have lower highs and lower lows. So I've got this high up here at the 135 level. The market's come down, it's come up, and it's made another high, a significant high, which is a little lower than this high. It's not the harmonic trending movements that we like to see, but all the same, we're still favoring short opportunities. However, because, and as I said, we're looking for high probability setups, right? So because this level here is where the market last danced at the 130.45, if we're to take a trade from here, so on a break here of a trend line, which we can put in like so, let's put in this trend line here. If we take a break of this trend line here, what we need to be aware of is the fact that we are coming up to quite a significant level of support, and the markets, and the markets tend to bounce at these levels of support. Whether we like it or not, however insignificantly, they will react with them. And let's take a look at this level here. It's bounced once, twice, 3 times, 4 times, 5 times. So the market has that level in its sights. Now, this does 2 things for us. First of all, we know that we want to get some of our position off of the table before we get to that level. Secondly, we know that if the price breaks through that level, that opens up a whole world of pain to the downside for the euro. And the next stopping point really, if we're honest, is going to be 128.75, and then below that 128.20, and below that, really you're looking for it to move down to the 126 level. So there's a lot of potential for movement here on the euro dollar. We may have to time our entries, maybe be a little bit more conservative if you're going to take an aggressive move here of the break of the trend line. So take a smaller position on, wait to see the reaction at this big level of support over here. And once you get that reaction, if it breaks through it, you want to be selling below there. Time frame for a 50 range is approximately a 4-hour chart waiting. Okay, so that's that for the euro dollar. The pound dollar is just a complete mess, if I'm honest. There's nothing really to see here on this chart. We've been in a range for pretty much, 6 months, a long time in any case. If what ultimately we're looking for here is we need a breakout above that level there, or below, certainly below this level here. And if we get below that, our next stopping point we need to be looking for is below here. Now the problem with that is, with regards to trend trading, is you're probably not going to get much of a trend in place until we get down to sort of like this 156 level. You will get some movement, but the MAs will probably only start to line up when you get down or around this level. And then again, it's similar to the euro dollar. You need to take into account this previous level of support, which actually was a resistance level in the past. Okay, these are the kind of things we like to see. Generally, these levels here, at the moment, because we're in a range-bound market, we're using them as places that we want to take some money off of the table or warning signs. But generally, when you're in a trending market, you would be looking for the price to break through that level and pull back to that level. If when the market pulls back to that level, it starts to roll over, then that's a very good signal for you to get into the trade, because what that's telling you is that that previous level of resistance, okay, so it's resistance once, twice, if we go back, it's probably resistance again, support once, twice, 3 times. So the market has reacted with this level many times in the past. Okay, now if we're in a trending mode and the market gets down below that level and it pulls back up to this level and it starts to roll over, that tells us that this level that's behaved itself, 6-7 times in the recent past, is about to behave itself again. And for that reason, we can look to take a trade from that level. Now, you don't always get these great levels to trade from. The euro franc is probably the best example. If you look back last year, it's just absolute dream to trade. But if you can wait for these types of setups, then you're going to put yourself in a very good position to make money. Okay? So that's the pound dollar. At the moment, we can't really say we're going to do anything with this. Things are quite negative here in the UK at the moment. So from a fundamental perspective, we might expect it to roll over. But right now, from a technical perspective, there really isn't much that we can do here at this very second in time. The Australian dollar is trending downwards, okay? And what we've got here, if I just squish this in a little bit, make it easier to see. So the Australian dollar is moving downwards. We are looking for selling opportunities on the Australian dollar. And what we have here, which is so much better than the other charts we've seen so far, is the market has pulled back to, take a look, previous level of resistance, support. There was resistance here. So you've got resistance here, support here. The market breaks through it, treats it as resistance. The market is back at this level again. Okay, fundamentally, what do we have? We've got the fact that China's slowing down a bit, which is good for, which is negative for the Australian dollar, because China is a huge consumer of Australian resources. So if China is slowing down, that's going to affect the Australian dollar. We're technically in a downtrend here. We've come to this previous level of support, which is now resistance. If we can get a rollover here of this chart, then we'll be looking to take this to the short side and basically see how this plays out for us. Okay? Does that make sense to you guys? So the Australian dollar so far is the only trade that we're entertaining at the moment. The dollar CAD. Well, this is just a complete mess. You can see here, this is just disgusting. This has never been price action. This is not something that you even want to entertain. This, really and truly, with this chart here, you want to wait for it to behave itself before you get involved with trading this pair. So we'll just skip this one for the moment. and the New Zealand dollar. Very similar to the dollar CAD, only it's now broken to the upside of the range that it was in. What we were looking at with our members is looking at this range here, and we're saying ultimately, until it breaks out of this range here, we're not really looking to entertain anything. We want it to get out, exactly, a choppy mess. We want it to get out of that range, hold above the range, and then give us an opportunity to go long, or break below the range, hold below, and then we'll look to enter it. So at the moment, there isn't a setup as such, but there are certain bullish indications here that this, that this could be going further towards the upside. So we're waiting for the moment to see that the price action can hold above this level. If we can get some momentum above this level, then we're looking to get long the New Zealand dollar. If we can't, then we'll just it'll come back into the range and we'll wait for another opportunity. Okay? The dollar franc. Well, this is just a horrific mess as well. There's nothing much that you can trade here. We were looking to go long a little while ago, but that, since broken back down towards its range. So again, this is a mess. And to be honest with you guys, this is part of trading. Sometimes no trade at all is the best trade. All right. You don't want to be just jumping into trades for no reason. You want to be jumping into trades to make money. And to make money, you've got to be taking the highest probability setups. Okay. So at the moment, this doesn't necessarily represent a high probability setup. The only thing that would push us to take a long opportunity here is the fact that you've got the Swiss National Bank intervening in the markets quite actively. So it doesn't have too much to the downside at this moment in time anyway. But there isn't a technical setup for us to be able to execute at the moment. The dollar yen, as we can take a look here, dollar yen, we're looking to take further moves to the downside. The problem with the dollar yen is, again, you've got Azumi in the financial press coming out and saying how they want to, they're watching the markets closely and they're looking to intervene in the markets, and they'll be active if need be. So even though technically you could say that you're looking for a shorting opportunity here, a few things you have going against it. One, fundamental news. Number two, this is almost sort of like the 50% retracement level from this big move up here. So it's quite a strong support level here. And number three, you don't have the moving averages lined up there. So what can you do instead? If you want to exploit some of the yen strength, but you don't necessarily want to do it against the dollar yen, you can start looking for opportunities in something like the euro yen here, okay, or the pound yen. Now, why would you do this? I'll just bring up the pound yen so you can quickly see that. Pound yen, and here we go. Now, why would you do this? So we know, or we believe that there's going to be some yen strength. Okay, the charts are setting up. That's what they're telling us. We don't necessarily want to go into the dollar yen. The reason is that that's the pair that the Bank of Japan are measuring everything on. And if that starts to break down, then obviously they're going to intervene in the markets. But they aren't necessarily watching something like the pound yen or the euro yen as closely, because that's kind of a byproduct of the euro dollar and the dollar yen and the pound dollar and the pound yen. Okay, so if the pound's weakening against the dollar's weakening against the yen, then surely the best trade to be in is something like going short the pound yen, or similarly go short the euro yen. So what we've got going for us here is we've got the moving averages aligned, which is nice. Okay, we've got a nice orderly pullback. The only thing we need to be wary of is this level of support here, the 105.82. Okay, so if you get your position on the table here, you need to be watching out for this level here, that blue level there, to maybe take some position off the trade, or maybe add to your position if you get through that. So take a smaller position running into that level. Once you get through that level, then add to your position. Let's take a look at the pound yen and see if it's a little bit clearer for us. Okay, so the pound yen, you've got a little bit more room to move before you get down to the major support level, which is going to be this guy here. Okay, we've got a little bit more room to maneuver and to get, to take our profit. So probably, if we're looking at this, from a trading perspective, we want to make money. Of all of the charts we've just looked at, really and truly, the pound yen and the Australian dollar, they're the ones that look best to me. They're the ones that if they break down, I'm going to be looking to trade. I can't trade, 20, 30 pairs all at the same time. So I need to cherry pick the very, very best ones. and there are always opportunities out there in the market, so you don't need to force a trade. And as we've seen here, even in these choppy, disgusting markets that we're currently in, you can still find one or two good trades there to take in that will hopefully make you money. Okay. What I'm going to do now is I'm going to open up the floor to any of you guys. If you've got any questions at all about the way of trading, about the markets, then let's have an open floor Q&A session before I have to I get kicked out and you guys get somebody else on board. So, any questions, guys? No? Yes, I only trade this way. I trade shorter term charts as well, Boyke. So I do day trade, but this is the only way that the approach, this is the way that I trade. So trend trading, buying support, selling resistance in a downtrend. Can I briefly show the euro dollar chart again? Yep, I can indeed. That's the euro dollar for you. Yeah, dollar yen, of all of the yen pairs, we're looking to exploit some of the yen strength. We prefer not to do it against the dollar yen. So something like the pound yen looks a lot better for us personally. But, you know, as I said, this is for educational purposes. I'm just trying to show you what goes on in my mind. Bit of a scary place, but show you what's going on in my mind when I'm looking to take trades. This isn't advice to say go and short the dollar, the pound yen or the euro yen or whatever. I'm just trying to take you through the thought process to taking trades so that you put yourself in the best position to be able to make money, because this is what we're here for, right? At the end of the day, we're not doing this for entertainment. We're doing this to make money, to subsidize your income or to replace it. So you need to treat it seriously as such. So for day trading, I use the 8 range bar. No, I don't trade the Asian session. Can I zoom into the charts? I can indeed. I prefer not to. And that's one piece of advice, actually. Before I do zoom into the charts, Axel, and I'll come to the question on stochastics in a minute. Before I zoom into the charts, what I see a lot of new traders do, and I'm not saying you're a new trader, I'm just saying this is what I see happen a lot with some of our members and something I try to discourage, is that they do like to zoom in a lot. So they like to, zoom into their charts even more than this. Okay, so let's see, what can we do here? So they'll zoom into a chart like that. New traders, this is what they'll do. They'll zoom into a chart like this, and they will expect to be able to know what to do. Now, for me, looking at this here, this looks like a great short. We've got momentum to the downside. The moving averages are there. I'm going short. I don't care. This is going short. This is going to drop through the floor because I'm so zoomed in. I don't have any context around the price. I don't know where the price has come from or where it's going to. That's why we need to zoom out a little bit. So if we come out here, oops. See, suddenly we've got some context around the price. Suddenly we can see that yes, it's a good opportunity to go short, but beware of the support level coming up here. Because if the market wants to turn around, that's the place it's going to do it, right there. But being zoomed into the charts, you can't see those levels. Does that make sense, Axel? Okay, using stochastics. How do I use stochastics? Well, I personally don't use them really very much. What I'm doing here is that a lot of our members, they want a much more straightforward way to trade, because the way that we trade, there's quite a lot of discretion in there. We're relying on our ability to read the markets and to read when the turn is and all of that type of a thing. So what I've been putting into place here are some filters which will allow some of our members to be able to get into the trade, to basically sort of like have an ABC execute. If these things don't line up, then you don't trade, rather than putting it down to your judgment on whether or not to enter a trade. And as you can see, we're not using any magic black box indicators. These are standard indicators that can be used, that are available on any trading platform. And we're just trying to find a way to give our members an opportunity to take trades without having to put too much of their own discretion there. So basically, the way that we're using the stochastics here is we're waiting for the cross to confirm the turn. And it's literally nothing more than that. It's really quite simple. Yes, the Asian sessions, it's not always slow, but I like to sleep sometimes. So, I can't be trading 24 hours a day. Yeah, the problem is, Axel, is I can't bring up two charts here. We tried this at the beginning of the session, so maybe next session I'll find a way to bring up both of the charts and hold them side by side, so you can see the difference. But, if you've got a euro-dollar chart on your screen, just bring up the 4-hour and compare it against what's on the screen here, and that should be able to help you. Yep, I appreciate what you're saying about the candles are so small, but you can zoom in to execute, but make sure that you zoom out of the chart to gain perspective. You really need perspective on this. Otherwise, you're going to trade into trouble. And that's the problem. When you're trading, it's not about just executing every signal blindly. You need to take into account, what are you trading into? What could stand in the way of my trade here? And that's the only way you're truly going to get across the line and be able to say, yep, I know when I wake up tomorrow, I'm going to be able to trade the markets, execute effectively, and I know over 1 month, 2 months, 6 months, a year, whatever it is, that you can come out ahead of the game. You see? Okay, for me to enter a trade, what I'm looking at, all right, let's take what was one of the ones, we said the pound yen's one that we're looking at. Okay, so I'm looking to enter the trade. What am I looking at here? Let's get some perspective. I'm looking at the fact that the market went up and made 3 highs, so you've almost got a triple top going on here. So 1, 2, 3 times, failed to get through that level. Right, once it starts to roll over here, the moving averages start to roll over. We start to get lower lows and lower highs, as you can see here. So actually, this was your first opportunity to enter short. That was a nice short there. And I'm thinking, okay, momentum's to the downside. Moving averages are lined up nicely. I've got a fair bit of distance here before I need to take some money off the table. I've got a nice level of support over here of my trend line. When I get the break below the trend line, I don't need a close below. You can wait for a close below on range charts because it's, you're not going to get if you're waiting for a close on a daily or a 4-hour, you may have missed the whole move. But on a range chart, obviously the close isn't that big, but you don't need a close below in any case. And once it breaks through this trend line, you can then look to get in there and take the short. Does that make sense, trying trader? Then you'd look to place your stop above the swing high there somewhere at around the 29.75 level. No, they're used separately. So the moving averages give you permission to trade. Okay. Once you've got permission to trade, then you can use the stochastics as some sort of confirmation for entry. But you don't look for it to time the moving average crossover and the stochastics. They're used individually. Do I wait for a pullback to the trend line? You mean the downward sloping trend line here? No, I'm just waiting. I'm using the trend line, the break of the trend line, so the break below the trend line as confirmation that it's rolled over, that the pullback is finished. Yes, the MA gives you the permission once the moving averages have crossed over. So you're not trading the moving average crossover. That's a massively losing system if there ever was one. Actually, that's not entirely correct because I did read a research paper about, one specific moving average crossover is quite profitable, but in any case, for me, it's not the way to trade. It just gives you permission, then you use price action to get into your trades. After the break of the trend line, correct. The moving average gives you permission to look for the trade, Sylvester. Not to enter a trade, it gives you permission to look. So now that the moving averages are pointing down, I have permission to look for a short opportunity. It doesn't mean there is one, it just means that you can look for short opportunities, and it takes the long opportunities off the table. So whilst the moving averages are pointing down now, I can't look for a long opportunity. Even if I wanted to, if I did, I'm going against my rules. And if I go against my rules and I get stopped out, I only have myself to blame. The 8, you can train primarily the 8. If you stick to the 8 boy key, then your strike rate, you should achieve quite a high strike rate. Generally, as long as it takes, Sylvester, because the 8 range, Sylvester, try and trade it. I give it as long as it takes, because ultimately, if you don't, then you're starting to let your own emotions dictate the trade. So unless you have a very set, time stop. So for example, you say after 4 hours, if it hasn't hit my profit target or stop, I exit the trade, and you do that each and every time. If you're just doing it and you're saying, well, it's been moving about for 2 hours, I think I'll just get out here. Okay, that's never been a great reason to exit a trade. You need to have some sort of an edge. You need to have something that's repeatable. That's what trading is about. And you need to find a system that you're able to rinse and repeat every single time. That leaves very, very little up to your imagination. And that's the way you'll be able to slowly cross the line and slowly move towards being consistent and moving your P&L in the right direction. It depends. It depends, trying trader. It depends on the momentum in the market. It depends on whether we have a fundamental bias, if we've got a fundamental view behind the trade. So we take a few things into account. But if you're just starting out, then you can either take all of your position off at the swing low, or you can take partial position off and trail your stop. But again, it has to be repeatable. Whatever it is that you decide to do, you need to make sure that you do it every time, not just the once. So once you've defined your own rules, write them down and never, never deviate from the rules. Just execute according to your rules. Any other questions, guys? What do you mean, what could be a possible combination with the moving average, Sylvester? An 8 revenge chart, Renee. Yeah, okay, let me see if I can bring one up here. Hold on. Let's get rid of that. If you give me a second. Okay, go to here. Can you see that now, guys? That's the 8 range chart. Sylvester, what I fear you're trying to do here, and I'm going to caution you against it, is you're trying to over-optimize something. Okay, unfortunately, we can't avoid fake outs. You're going to get them, you're going to lose. You're going to lose trades. You need to embrace it. There's absolutely nothing you can do to avoid losing trades. You just have to accept that they're there and move on. All right? A lot of struggling rookie new traders have this issue where they find a system and they think, if I optimize it, I can get the strike rate up. What you need to be worried about is the bottom line. Of course, you need a strike rate that suits your personality, but you're never going to get 100%. All right? So please take my word for it when I say what I'm showing you here, it can make you money. All right? It can, but you have to be able to trade it. And what I'm showing you here, it could be optimized, but then you could over-optimize it and you could completely ruin it. So what you should really do is take the foundations here that you see here and see how you can work with it as a trader. And don't worry too much about over-optimizing and trying to avoid fake outs, because you are always going to lose trades. I guarantee you will lose trades. But then you know what? If you follow a system, I guarantee you will make money on trades as well. Okay? If there are pivot point or round numbers between the swing low target, would you reconsider taking the trade? I generally don't use pivot points, so I wouldn't be able to comment that much. I mean, it may be a reason to rethink, but I'm not sure it would be a reason to not get into trade completely. Better for a scalp or short trade. Euro bias would still be to shorts. Yeah, I mean, Euro at the moment, fundamentally, technically everything, you're looking for shorts and opportunities, really. How do I come say that a 50 range is about a 4 hour? You're probably not going to like the answer here, Boyke. Visually. You know, I went through, the 4 hour chart was a time-based chart that I liked to trade. It was my preferred time frame, and when I started looking into range bars, I wanted to see what was roughly the equivalent. So I kind of went through a few, you know, 20, 30, 40, 50, 60, so on and so forth, and kind of came to the conclusion that you get similar moves on the 50 range chart as you would a 4 hour chart. So there's nothing amazingly scientific there. If you wanted to be, you know, very proper about it, you could use the average true range or something. So use the average true range for a 4 hour bar and then use that range there. Yes, there's no time on a range bar. It takes as long as it takes, and that's why it eliminates some of the noise. To get the range chart, Sylvester, there are plugins available out there on the internet if you go to Google and stuff like that. I personally don't use them. I use NinjaTrader, as you can see in front of you here, and they're provided as standard by NinjaTrader. Any other questions at all? You still like me? Thank you, Boyke. That's going to make my weekend. I still like you too. How many pips above the high do you place your stops? Generally, if it's on a, if I'm trading my intraday, then I'll put it maybe 3 pips above, but I'll watch it, and as soon as it goes a pip above on the chart, I'm out. If I'm trading on a longer term basis, probably around 5 pips, something like that. When will be the next webinar about the same topic? I believe in 2 weeks. Our friends at FX Street can confirm that for us. But is it correct in 2 weeks we'll be back here for another webinar? Do I have any books to recommend? On range bars, no, but I do have some books, some fantastic trading books, which I love, and you guys should read them. If the trading books I like, Marty Schwartz, Pitbull by Marty Schwartz, it's my favorite book ever, trading-wise. It's not going to give you a system as such, but it takes you into the mind of one of the most successful traders on Wall Street. And the other one is One Good Trade by a guy called Mike Bellafiore, who he runs a prop firm in New York, and that's also a great book to read. So they're my 2 favorite trading books of all time. Can I write the name of the book here? I can indeed. There are some if you go to on FX Street to the archive webinars that I've done, you'll see that there are some recordings of this. And Vicky or Maud or anybody, could you possibly type the link in here for them to be able to get to the archive, to be able to see the videos, the previous webinars? Any books that I author? Not as of yet, not that have been published anyways, but you never know, one day. Done by Vicky. And the other one is One Good Trade. Let's see if I can spell his name correctly. In fact, it's up there on my, I will, because I have it in my library. Bellafiore. The Marty is Pitbull. I've just put it in above. Pitbull. These guys, if you want any 2 trading books, I promise you, these are the best. I've never read a better trading book than those 2. Entertainment value, pitbull, is 100% the best. A bit more educational value, one good trade. One good trade is more directed towards stocks. I mean, none of them are currency books, but what you need to start to do is look beyond the buying a book just for the system and look for the little nuggets of information that you can get from experienced traders inside of it. Okay guys, so I think we need to wrap it up here, but thank you very much for coming and watching and listening and talking and interacting. How you come across Renko bars reflect pip moves. I'm not sure what that means, Charlotte, but if you drop me an email, Charlotte, we can talk about that in any case. Thank you very much, everybody. It's been a pleasure as always. Have a very happy week, and I look forward to speaking to you all soon. Alex Ong, over and out.